All right, options traders, listen up. I want to tell you a bit about public.com. But first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees. And in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. To recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for option trading, and start earning up to 18 cents per contract traded, only at public.com. Paid for by Public Investing, options not suitable for all investors and carry significant risk. Full disclosures in podcast description, U.S. members only.
Welcome to The J-Rowe Show. On this podcast, your host, John Rotanti, interviews experts in and outside the world of investing. The J-Rowe Show dives deep into what it takes to achieve mastery and sustain top-level performance. As a quick reminder, this podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. All opinions expressed by John or any of his podcast guests are solely their own and do not constitute formal advice or recommendation. Now please enjoy this episode.
I'm John Rotanti, and this is The J-Rowe Show, a podcast that explores what it takes to achieve mastery, sustained performance, and longevity. The show hopes to uncover the processes, structures, frameworks, and mindsets that professionals put in place to maintain winning performance in their respective fields. Today, I am joined by Ric Dillon. Ric is the co-founder, CEO, and chief investment officer of Vela Investment Management. Prior to Vela, he founded Diamond Hill Investments, a publicly traded company with the ticker DHIL. And during his tenure as CEO, Diamond Hill ranked in the top 1% of all public companies in the U.S. in terms of total shareholder return, with an annualized total return of 27%. In other words, Ric Dillon is the embodiment of the Warren Buffett quote, "I'm a better investor because I'm a businessman, and I am a better businessman because I am an investor." Ric, as a former Diamond Hill investor, I thank you and welcome to the J-Rowe Show.
Thank you, John. It's a pleasure to be with you.
Ric, tell us about Vela Investment Management.
We started 4 years ago. The company Vela, the name Vela, a Latin word for the sail of a ship, for us is an acronym for the 4 foundational principles, which are a valuation-centric philosophy, implemented by experienced investors, that's the E. The L stands for long-term, and that is both in terms of our investment time horizon as well as how we run our business. And finally, the A, alignment of interest. We are invested side by side in the same strategies as our clients.
I love that, Ric. I love that. What type of investor are you, and what types of businesses do you like to buy stock in?
The idea of being valuation centric, and we're real careful with the choice of those words because we believe, as Buffett says, that growth and value are part of the same equation. Mm-hmm. And so we wouldn't want to be labeled simply as a value manager, although some people will do that, and that's okay if that's what they choose. But we're placing a valuation on the businesses that we invest in, and we'll pay more in terms of a PE ratio for the higher growth companies than we would for the lower growth companies, but we're always estimating the intrinsic value based on a 5-year discounted cash flow methodology, and we want to get a margin of safety, i.e. a discount from that intrinsic value estimate.
What is your portfolio management philosophy? How many stocks do you typically own? What is your average starter position size? Maybe what is a full position size? And do you typically hold cash, or are you fully invested?
We have several strategies, and they range from a focus strategy, which is only 10 to 15 holdings, and then we have an all-cap concentrated strategy, which is 20 to 30 holdings. So the focus strategy is a subset of that all-cap concentrated strategy. And then we have a large cap plus strategy with approximately 50 holdings on the long side as well as short positions. And our small cap strategy and our international strategies, we run typically approximately 50 holdings. So in all of those strategies, we want to have a high active share. We want to be considered always as an active manager, never as a low tracking error type manager.
You mentioned the long short strategy. So Vela and your predecessor company, Diamond Hill, are one of the few investment managers that I'm aware of that offer a long short mutual fund. And I think this is one of several things that distinguishes you. So why do you offer a long short strategy as one of your mutual funds?
Well, there's a few different reasons. First, from a firm perspective, the overarching goal is to be the best investors that we can be. And I think if you're a long-only shop, there's a tendency for an optimism bias that we want to avoid. And so by having the ability to short stocks, we can have an industry or a company which our analysis suggests it's better to be short than long. And having that ability then makes us a better investor to be able to always know both sides of the thesis, the long side and the short side. So as a firm, we want to always have that ability in total. We do it in the large cap plus strategy because for a few different reasons. The large cap, of course, is an area where you're less apt to have stocks that will go hyperbolic. And having said that, we've seen some hyperbolic large cap stocks in the last year or so with the AI boom. And fortunately, we haven't been short any of those.
Yeah.
But so you have an ability to borrow shares at a reasonable price. And once you get below the large cap, it becomes more of a challenge. And so we would just prefer staying in the large cap space with our shorts because we are shorting individual names. And so being able to borrow those to short is an important factor. So it is the only strategy where we do shorting.
Do you use options? Why or why not? And if you do use options, which do you use?
Yeah. So again, the large cap plus strategy, we use options, both written calls, covered calls, as well as puts. We'll use sometimes we'll use strategies where we're trying to hedge both sides of an existing position. Occasionally, we'll be using options and that strategy for tax efficiency and risk management. In our small cap strategy, we pretty much stick with covered call writing, again, generating income, but also mitigating some risk. We have, from a tax efficiency standpoint, had a rare example of using a put to hedge a position that was short-term, and we wanted to wait until it was long-term before we sold it, just because the tax treatment was so dramatically different. But primarily in the small cap, it's just income generation and some risk control. But in the large cap plus, they're much more actively used for a variety of reasons that I said.
Yeah, I just really like the flexibility that you allow yourself in that large cap plus strategy, going long, short, and using options. Go ahead. Were you going to say something? I'm sorry.
I was just going to say, as we all know, with large cap, if there is a area of market efficiency, and there is, I think, to a degree, it's going to be in the large cap area. And so I think it's incumbent on an active manager to have that kind of flexibility to use shorting and options to augment those returns. Our goal, of course, is net of fee to add 200 basis points over a passive alternative in our large cap strategy. And so to do that, I think we need that additional flexibility. And that's why the name plus is added to large cap, just to indicate it's not just a traditional long only large cap strategy.
Oh, I love that. I like how the name speaks to the strategy, as well as you just called out your sort of return goal is 2 percentage points higher than a passive index annualized over time.
Yes, exactly.
Awesome, Rick. So you mentioned one of the reasons to use options was risk mitigation. So how do you think about risk management in the portfolio? And just how do you think about risk management in general?
So to start with, we think that the best way to think about risk is in terms of loss of capital. And so investing in companies that we have a fairly good understanding of what the business prospects are, certainly we want to know what the balance sheet looks like, and we again back to the original point of estimating what the company's worth, have some kind of margin of safety as a risk control, a discount from that estimate of intrinsic value. We think those are all fundamental ways to control risk best. On a portfolio basis, we use absolute limits to both sector and industry exposures. And I think that's very important, and I think it's different than the norm. And what we're saying there is we don't want to have more than 30% in any sector and more than 20% in any industry. We want to be sure to have absolute diversification. And so what that is addressing is the idea of an active manager not hugging a benchmark, but instead really trying to control risk on an absolute basis, that again, that permanent loss of capital. And we do think in terms of 5-year periods. And so any of our equity strategies we think about them as risk over a 5-year period. And we would want to have it be a very rare, unusual circumstance to have a loss in a 5-year period.
That all made a ton of sense, and a lot of different levels of risk management there. I would like to dive deep into the research process at Vela with the next several questions. So to begin, how many people are on the investing team, and are the analysts typically generalists or sector specialists, and why?
I'll start with the second one first. It's industry specialists. And the reason is we think that the more focus that you have, the better you are at understanding. And so they tend to follow one or two industries. And to your first question, we presently have 14 people on the investment team. We have a new analyst starting in July, so that'll take us up to 15. But our younger analysts tend to work with our experienced analysts as part of the process. And so that's the area where we're building out the most now, that the new person is a younger person joining us right out of school. And we're excited to have her. But we have, and we'll probably build that group 1 or 2 a year for at least the next 10 years.
Oh, I love the long-term outlook, Rick. I remember I owned stock in your predecessor company, Diamond Hill, and I remember one of the stats, one of the metrics the company used to report when you were the CEO was, I don't remember, I'm not going to remember the exact metric, but it was some metric that showed that there were more people on the investing team than there were on the marketing and sales team. And so there was a real investment focus at Diamond Hill. Am I correct about that? Am I remembering that correctly?
You are. And just to put a finer point to it with Vela, just last month we hired our first salesperson, Emily Straw. So we're excited to have her. But for the first 3 years, we were focused almost entirely on our strategies, the investment of our strategies. And we thought we'll start after the 3rd year, we'll start building out the sales. And so we hired our first person.
Excellent.
Recently.
I'm sure Emily is going to do great. I'm sure she's very glad to be part of the team. How many stocks does a typical analyst cover at Vela?
So I would say in terms of active models where at least quarterly the estimate of intrinsic value is being calculated, and those are rolling 5-year, rolling quarters forward, so a 5-year discounted cash flow that continues to roll with time. Probably on average 20 of those are current, and they probably, depending on their level of experience, have another 20 or more that maybe they've had models, but they're not current because we don't currently have a holding. Maybe a price decline of a stock would get them to dust off that model and get current on it. So it functions like that. But in terms of active models, it's probably closer to 20 where they're being updated currently on average.
Yeah, embedded in your answer there, I think, tell me if I'm right, one of the expectations of an analyst at Vela is to maintain active models on their core universe of companies they follow, to have to update the model quarterly and have an active model.
Yes, and our portfolio managers are also research analysts. They are, as I said earlier, are often working side by side with the younger analysts to develop them, but they will always be research analysts. Jenny Hubbard and Jason Downey are two of the best investors I've ever worked with, and I've known them both for over 20 years, and they intend to follow 20 and have active models on 20 stocks for the rest of their careers. And so Bobby Murphy, who's our director of research, does an excellent job of working with our research analysts and our research associates. Those are the younger people, and working side by side with him. And I think that what we want to make clear when we're talking with our prospective hires is that it really is a collaborative effort. We want our PMs and our senior investors want to be involved at the beginning of the process. And so they, not just for the development of the younger people, but also just to know whether or not it's the area where they want to focus, so that there's no surprises on anyone. And so that kind of collaboration, I think, is vitally important. And Bobby stresses that always when talking with our analysts and our research associates.
I love that you called out Bobby and Jenny and Jason. I know Bobby, and I've had several calls with Bobby, and because I know Bobby, I actually got to have a call with Jenny and Jason, and they're fantastic, and they're so kind and generous with their time as well. So that's just great. So about 20 stocks they cover and maintain active models and active current estimates of intrinsic value. About how many new ideas are analysts expected to find and pitch each year?
That's an excellent question, and it's hard to answer because of the various strategies. So there'll be some people, for instance, who might only have one or two a year because their focus is more narrowly on a strategy or two, whereas others might have investments in several strategies. A good example would be Jenny, in that she has not only some consumer names in the small cap area, and as the lead portfolio manager, that's what you would expect. That's her area of expertise over her career. But she has some in our large cap strategy, and she has some in our international strategy. Wow. So she probably contributes, half dozen new ones, and that's from an analyst perspective per year. Whereas some of our younger folks, or some who are more, are one of our newest hires actually is a guy with a good deal of experience, and his focus is primarily in our income opportunity strategy. So I would doubt that he would have that many, because I would doubt that he would have many, at least in the near term, going into our other strategies other than income opportunities. But over time, I wouldn't be surprised if he had that kind of impact on other strategies as well. So it really is, it really does depend. Our people who are at Vela love the business that we are in. They love the people that they work with. And so there's no kind of artificial, you've got to do this many per year, or anything like that. We expect everybody is working to the best of their ability, and when they, to use the Buffett phrase, when they see the fat pitch, we expect them to swing at it.
Mm-hmm.
And again, going back to Bobby as director of research, he really wants our analysts and associates to never be in a situation where they're at all afraid to swing at that pitch. And so that kind of collaboration that starts at the beginning, and that atmosphere of communicating all along the way. Some firms, they have the analysts go pitch the PMs, and we really don't do that. We're really collaborative the whole way. Ultimately, the PMs will make the decisions for their strategies. The lead PM in each strategy has final decision rights, but there's still a tremendous amount of contribution by the analysts and associates with how they work with the PMs and the research responsibilities.
Very, very interesting. So I think I just heard you say that, an analyst is not going to make an official pitch to a PM. Rather, the PM and the analyst are collaboratively working on the idea throughout the whole process. Is that pretty accurate?
Yes. And so let's just use an example.
It's iterative. Yeah.
Exactly. And so one of our youngest associates is a fine young man named Max Grog. And so he might have an idea about a name, and he will go to the appropriate PM and say, I'm thinking about this name. And the PM might say, that looks interesting. Why don't you look at this and let's talk about that. Let's come back to it, and why don't you work up a model? And that kind of, as you said, iterative process ultimately results in a decision to buy the security or short the security, depending on the situation. And so it's not really the pitch at the end like you have, but instead that process throughout. And what we believe, and Bobby again is the champion of this, is that creates an environment where everyone really does feel like they're part of a team, because they are, and they're not intimidated. We're all going to make mistakes, and that's the nature of being a human. And so we don't want those to be the kinds of things that create any kind of adversarial relationships.
Absolutely. In addition to the model, is there a write-up sort of putting the investment thesis into words? And
Yes.
When they're updating their models quarterly, are they, writing a little blurb to share with the team?
Yes, absolutely. In fact, both the financial model that they build as well as the write-up is pretty thorough. And so and that's very valuable. It's especially valuable. Well, it's valuable in a lot of ways, but one way is, of course, as you build these models, you get a deeper understanding of the economic drivers of the businesses. And when you write the thesis, similarly, as one person once said, I don't really know what I think until I've said it.
Yeah.
So I guess it'd be the same as until I've written it.
Yeah.
And so that's an important process, but it's also helpful in the ex post analysis that we do, which is where have we made mistakes? How can we get better? What did we miss here and there? And so by writing it, having it in written form, we're able to do that and say, well, this is what the thesis was, but this is how it played out.
Yeah. Yeah. That's an important point. I've always believed that if I have an idea in my head, I have a thesis in my head and I can't translate it into words, then maybe the thesis isn't as strong as I thought it was in my head. And so crystallizing it through the writing process is quite powerful and valuable, I think.
I agree. And I like the way you said that.
Thank you. Thank you, Rick. Please talk about the idea generation process. How does your team source new ideas, and how do you narrow down your investing universe?
So some of it, again, the industry expertise is very helpful in that regard, because if you follow an industry and you see what's going on with the companies in that industry, you have a better sense of their competitive positions and their valuations. And so that's one of the, going back to an original point, that's one of the reasons for that idea of industry expertise, because generally speaking, we're bottoms up investors. So we have some reason to be interested in a company. And there are obviously some examples like commodity businesses where the macro thesis is important for commodity prices in terms of supply demand. But more often than that is where we like the company, how they're positioned. We like things about the management of those companies, how they're aligned with shareholders. We're always looking for a strong balance sheet because we think that's important. We actually think over the next 10 years, that's going to be especially important given where we are in terms of our government debt. We think that results in the need for companies with good balance sheets due to the crowding out effect of a lot of treasury issuance for as far as the eye can see. So it just depends. Now, some of the younger analysts from trade publications and so forth go into conferences. They're going to come up with some ideas that way. Sometimes some of our more senior people will suggest to some of the younger people, this is a company I used to follow. Why don't you take a look at it? There's been some changes. And so that it's multifaceted how we could come up with the ideas, but we're all expected to have ideas, and we have what we call wish lists of names that maybe we can't buy just due to the extended valuation right now, but if it ever became attractive, we could. And so everyone maintains that wish list to come up with some new ideas when the opportunities warrant.
You mentioned you're primarily bottoms up, but occasionally for certain industries like commodities, you have to be aware of the macro backdrop and supply demand dynamics. How much time do you spend thinking about the macro backdrop? And do you currently have a market or macro outlook that you hold with pretty high conviction?
Well, I'll use one example, and this is it's in the energy space, and it happens to be an area that I've been involved with since I was a young analyst. So that's 45 years ago. Yeah. I started following oil and gas. I was a member of the industry trade group, NAPIA, was the acronym, and so that was, and it was, if you recall or read about back in the late 70s, early 80s, you had some extreme price volatility and so forth. And so because of that history, when we started Vela, I had the view, and others had the same view, that we probably have been too optimistic about how renewables can take hold worldwide. That'll most likely take much longer than what the optimists were hoping for in terms of especially wind and solar. And so we took a position, and the companies had become much more disciplined from a capital allocation standpoint. And so it was sort of a perfect time to have a meaningful position. We were nearly 20% in our small cap strategy because of this view. And that happens to be the one where we did use the put options on the XLE till we got long-term on some of those because they did very well. We still hold that view. Again, the stocks have done pretty well, so they're not as attractively valued as they were 3.5 years ago. But we still hold the same view that it's going to take decades and a lot of natural gas in particular to get us to where we want to be as with renewables. So that's one of those examples where it's a sort of a macro view that we hold pretty strongly. Similarly, what I alluded to earlier with regard to the fiscal situation in this country, and as a result of that, that becomes a headwind, especially for companies with weak balance sheets, because we don't believe interest rates will come anywhere close to the lows where they were in the last decade. I think zero interest rate policy will be written about how a country like ours had that for such a long period of time. Isn't that odd? And but I don't think we'll see it again. not for probably 50 years. So, or if ever. So anyway, that's another example of a macro view that we hold pretty firmly.
Rick, it's so funny. I tweeted out maybe 2 weeks ago that there's going to be a book written on the ZERP experiment and how literally over 15 years of 0% interest rates, it's almost crazy to think about.
It is.
It hurts the hair, hurts the mind to think about it. But yeah, I think there are going to be some really good books written about that. Just really quickly, I know there's not a formal stock pitch at Vela. It's an iterative, collaborative process the whole way out, very team oriented. But what makes a good investment thesis? Is it the discount to your estimate of intrinsic value, and what you see differently than the market? Is that the crux of it?
Well, it can be, certainly. But and what I'm about to say probably applies more to small cap than large cap.
Mm-hmm.
But we have maybe upwards to 10 holdings in our small cap strategy that the street doesn't follow. And
I love that. Yeah, I love that.
Yeah, and so we love it too. So in that instance, we need to be very familiar with the managements and the businesses at a very deep level, because it's all on us. And then we like how the managements have positioned the company, not only with their vis-a-vis their competitors, but also if they've aligned their economics with shareholders. And so reading the proxies is very valuable in that regard. So the perfect company may be at a small discount, but yet I called it perfect because all the other things were in alignment.
Mm-hmm.
When you get a bigger discount from your intrinsic value estimate, that gives you the definition that Graham gave and taught Buffett was that greater discount mitigates a lot of risk. And so in those instances, perhaps something about the industry is more competitive, and therefore the moat is not as large, and therefore getting that discount can be very valuable. And sometimes those discounts occur. We've seen a lot of volatility over very short periods of time with names, and it goes back to that comment about the wish list. All of a sudden, the name is attractive, whereas just a couple days prior, it was not. Mm-hmm. But the volatility was so great. But then again, you better have a very current model and a great understanding of those drivers, because perhaps it went down for a very good reason, and there's more to go. So you dust off your thesis and make sure it's very sharp in those examples. So it just depends. We've got a company, BWXT, that is probably not, well, it's disclosed that we have it. So anyway, but it fits that parameter of a company that we like the businesses that they're in, and they have a pretty big moat, and there's lots of reasons to believe that they're going to be able to extend those business lines, given the lack of competition. Their main business is nuclear propulsion for submarines. And so clearly in the case of defense spending and so forth, that's a push by itself. But going back to what I said earlier about energy situation, nuclear ultimately needs to be included into the conversation and expanding that. And so tangentially, you could imagine BWXT getting some benefit from that too. So with things like small modular reactors, things like that, that are being talked about, but none exist in this country today. So anyway, that's an example of a less of a discount to estimate of intrinsic value, but a solid company and business prospects and their competitive position and the management and so forth.
I love it. Thank you for sharing that. Nothing spells moat like lack of competition. So I really like that. So talk to us about valuation. How does your team think about valuation, and is it primarily driven by the 5-year discounted cash flow models, or are you using, other valuation methods and tools as well?
Well, generally, it is the 5-year discounted cash flow methodology that we use. There are occasions where we have to supplement that. So, for instance, in biopharma, we have some small positions in some of those companies where they may not have profits at all at this point. And so, so looking at their intellectual property, again, Kyle Schneider, who is our healthcare specialist, does a great job with that. And it's been a good source of investments for our small cap strategy. So occasionally we have those kinds of situations. We have occasionally had to look at sort of asset values in terms of positions, not necessarily from the free cash flow perspective, but what's maybe in the ground. So for instance, gold, we have some positions in mining companies, both international as well as our domestic strategies. And that could be another good example. But generally speaking, it's the 5-year discounted cash flow methodology.
And then you're using a terminal multiple after year 5?
Yes. And so we have a valuation model that what we call the first approximation that uses a calculation for that terminal multiple. But when we invest and come up with our thesis, every investor, PM, analyst, associate is able to, in effect, override that first approximation and put on whatever they think is best. So it's just what I said, a first approximation. And the idea of that first approximation is simply over time, competition will move PE ratios toward, not to, but toward a mean. And so that's why we have that as a first approximation, but we certainly let each investment person come up with their own as part of their thesis.
Earlier in the show, you heard us talk about the investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing, options not suitable for all investors, and carry significant risk. Full disclosures in podcast description, U.S. members only. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the last 10 years? FinChat's got it. Like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. Want to see Home Depot's average ticket price or sales per square foot? FinChat's got you covered. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat and love it for the KPIs I can't easily find anywhere else, the awesome screener, and the quick and easy charting tool. To get 15% off any paid plan, go to finchat.io/JRO. That is finchat.io/JRO to get 15% off any paid plan today. The link will be in the show notes. Such a powerful statement, how you made that distinction towards a mean and not necessarily to the actual mean. Really, really powerful statement. Talk to us about selling. Under what circumstances do you trim a position, and under what circumstances do you sell out completely?
Well, I'll again start with the second one first, and I'll start with the bad example. I'll never forget this when we had this goes back 20 years, but it was so dramatic. We had an estimate, and I'm going to round the numbers because I can't say that I remember them exactly.
Sure.
But we had an intrinsic value estimate at the time of Merck at approximately $50. And this is, I think, 2004, if I remember correctly, 2003, 2004. And the stock was trading at 42. So it was a pretty good discount to our estimate of intrinsic value. And then the next morning, we wake up and they're pulling Vioxx off the market, their most profitable drug, if I recall correctly. And our estimate went from 50 to 30, I think to 30 or 35, 30, I think, something like that. And the stock opened, it was 42 the night before and it opened at 36, and we sold every share immediately because we no longer had a discount. And we took a loss in it, but that's exactly what we did in that dramatic example. So when we make a mistake, when we're wrong about something, it's best to just admit it and exit. And so that's a dramatic example of a big company. Sometimes the company simply reaches our estimate of intrinsic value, and we can't come up with any kind of justification to raise our estimate. Mm-hmm. If we were to keep the stock, and I'm setting aside for a moment tax consequences, if we were to keep the stock and it is selling at a price greater than our estimate of intrinsic value, we would have left our valuation investment philosophy and we would have entered into the speculative realm where we're saying, well, we think it's overvalued, but we think it might still go up or whatever. So we don't want to do that. That's not what we do. That's not our discipline. So if we can't come up with a justification to raise our estimate, then the discipline is to exit the position. Trimming can often occur as we're approaching our estimate of intrinsic value. We have limits on position sizes, 6% on our more diversified strategy, certainly not in our focus strategy where we've only got 10 to 15 names. But when they get to the limits that we have for each strategy, towards those limits, we'll tend to trim. Again, especially if it's a very narrow margin of safety. So those are typically where we're trimming. If we had a situation where we had no cash, we might trim a position simply to provide cash for another investment. Mm-hmm. That doesn't happen as often because we always have a little bit of cash, 2 to 4% probably in most strategies, and so we don't. It's rare that we would have to trim a position simply to provide cash for another name.
Yeah. Rick, how do you spend the quiet time in your office? What are you reading? What's on your computer screen? So
in addition to the main periodicals like the Wall Street Journal and the New York Times, I like to read some of the sell-side research that we subscribe to. Mm-hmm. I do like to read other kinds of publications, trade publications. As a supporter of American Enterprise Institute for Public Policy, I like to read their thought pieces. They have a tremendous number of thought pieces produced by their people there that I think are great. So those are examples. we're always reading. I can't think of too many fields where you would read more than in our field, because
Yeah.
there's just that's what we spend our time doing, reading and building models. I'd say that's 90% of the time that our PMs and analysts spend would be just those two activities.
Yeah, no, it's a pretty good summary. Reading, and then the synthesis and the analysis flows through the model. And so,
Yes.
yeah, you're exactly right. Um, so, Rick, you're a proven investor and business builder, and one of your co-founders at Vela is Lisa Wesolek, who is the former chief operating officer at Diamond Hill. So both of you were officers and members of the executive leadership team of a public company. And I already mentioned that during your time at Diamond Hill, you were one of the best performing CEOs in the US, generating annualized returns of 27%. So Vela has a great pedigree to build off of. So my question is, where do you see Vela going in the next 5 years?
We plan to add a couple more strategies. We'll probably have 3 to 5 new people a year over the next 5 years, and we'll always, first and foremost, try to provide good returns for our clients, and so we're always focused on that. But we'll just continue to build naturally as we did. It's a very similar trajectory as we had at Diamond Hill. And so, not surprisingly, we're using a similar kind of playbook. There will be some things that will be different because of how the industry evolves, or how the regulatory environment evolves. But generally speaking, we'll just add strategies and people to build the business.
Similar playbook. So we dove very deep into the Vela investment process today. Is there anything we missed, or anything else you'd like us to know about Vela, its process, or how the team is structured and how it works?
I would simply reiterate the idea that it's a group of people, 28 of us now, who love investing, enjoy each other, and so we choose to spend our time doing this. And I had a brief retirement of a little over a year, and I just feel so fortunate to have this opportunity to build Vela. And I have no plans to retire ever again. I think it was Warren Buffett at his annual meeting this year where he said, don't come to Berkshire Hathaway if you think you're going to retire at 65. And so that's the way I think about it. And I'm just very fortunate to be with people who I have such a high regard for. Vela's been an easier build than any of the previous ones, primarily because of those people, because of Lisa and Jason Job, who were there on day one, as well as Jenny and Jason Downey and Bobby Murphy and Bob Sharp, who's got tremendous experience. I never worked with Bob before, but it's great to have a guy with over 40 years of experience, other than myself. And so Kyle Schneider, it's just been a real joy, and I'm excited about our future and the people we'll be adding. We have 6 interns.
That's awesome.
This summer, and for a small firm, that's a lot.
Bobby's going to be busy. Bobby's going to be busy.
Yeah. But the quality of them is just excellent, and so it's fun. It's really a lot of fun doing this. I'm just so grateful to have this opportunity.
You said you enjoyed working with all of them, and obviously they've really enjoyed working with you because they came to Vela. So that is awesome. Rick, thank you so much for coming on the show today. It's just been a pleasure.
Oh, it's been my pleasure, John. Thank you.
Thank you. Before we sign off, I'd like to provide a quick reminder. Anything discussed on the J. Rose Show by myself or my guest is solely our own opinions and does not constitute formal investment advice or a recommendation. The J. Rose Show is for entertainment purposes only, so please do your own research on any securities discussed in this podcast. Thanks for tuning in, and we will see you next time.